Hello and welcome to the November edition of the Global Perspective. This is a monthly program where we round up our fund managers from around the world, our partners that we work with, and we dig into their specific expertise and try and get some really deep insights into what's going on in particular equity markets and bond markets around the world. Today, I'm delighted to have Robert Promisel, portfolio manager on the Global Property Fund, Nedgroup Investments Global Property Fund, and a long-time portfolio manager at Resolution Capital. Rob, thanks so much for joining us today, all the way from New York.
It's a pleasure. Thanks for the opportunity.
So, some of you may have seen in the invite that we've had a really torrid time for global REIT markets this year, and there's been a real divergence between some of the best performing companies and some of the worst. Now, driven by persistent inflation, hiking interest rates, and people's perceptions that long duration assets such as property should actually perform slightly poorer in this environment. Now, we're going to dig into this, and the first question I'm going to ask you, Rob, is what are the key aspects that you dig into as portfolio managers in the REIT space that might have been driving the performance of some of these REIT companies around the world in 2022?
So, it's so easy to try to make this complicated, but it's really about demand and supply for the real estate in the individual markets. Because when you invest in a property environment, whether it's a company or a market where there is strong demand that is in excess of the competitive supply, there's scarcity value to the real estate. And when there's scarcity value to the real estate, landlords have rental pricing power, and they can drive their rents. They can drive their rents up. And in an inflationary environment, that's really, really constructive because the landlords have pricing power. They're able to drive rent growth that's at or above the rate of inflation, and thus they can have real rent growth. And so we're actually really constructive about real estate in an inflationary environment, provided that there is scarcity value and that demand is in excess of supply. I think some of the challenges that have really hit the real estate space this year have been concerns about demand, concerns about whether there's going to be a recession and whether we've seen peak demand and what the deceleration in demand is going to look like. And there's no doubt that in many places, demand has plateaued and could be slowing. But we're not really fearful of that because we actually think that competitive supply, is slowing even more. The increase in interest rates that we've seen have had a very significant cooling effect on new starts and thus on the delivery of competitive supply over the next several years. And so, provided that we don't hit a very deep and long recession, provided it's just, if we do have a recession, just a shallow recession, we think the environment, the mix between demand and supply, could be actually quite constructive over the next couple of years. But I would tell you that we just don't know what will happen with demand because of the uncertainties. The commitment by the Federal Reserve in the U.S. to control inflation, even at the expense of the economy, that's a message that is coming through loud and clear. And so there is real concern that demand could turn negative, that we could see a reduction in rents and revenues if occupancy were to fall. And so there's definitely worries involved with real estate today. But we also think that the supply response is going to be seen as really quite supportive once we see a stabilization in demand.
Thanks, Rob. And which of the areas or the segments of the REIT market have actually got the best dynamics at the moment? Where are you putting more money to work and seeing a positive imbalance in that demand and supply and the ability to continue to push rent?
So, I want to talk a little bit about retail, and I'll answer your question, Rob, but I want to do it in a little bit of context. We had a much lower weighting in retail globally early in the pandemic. We were concerned about, first of all, in many markets, shopping malls were closed due to health concerns. And that situation really allowed e-commerce to take off. It was an accelerant to e-commerce fulfillment. And so you saw the rise of Amazon and other e-commerce players. Um, However, as the pandemic kind of worked through, and we're now in a recovery phase, we've seen, and people are out and about. We've seen a real big support, groundswell of support for physical retail shopping, but specifically for grocery anchored shopping centers. People want to get out. There's a socialization aspect, but more importantly, um, outdoor shopping centers that have a grocery anchor are terrific fulfillment options for retailers. Everyone realizes that last mile delivery from e-commerce firms is very expensive, and in many cases it's not profitable. Um, but when you have a neighborhood shopping center that's located in the community that it serves by virtue of the grocery store anchor, um, it's a necessity shop, and you see more and more customers that come to that center every week or multiple times a week. And while they're there, the retailers have figured out they can actually do fulfillment, so the customers can order online, and in an omni-channel world, they can actually pick up what they order in the stores. And so that's actually a really good solution for retailers. So we've seen a few things happen during the pandemic. One, there was a cleansing of problem tenants. And so the tenant base for the retailers, for the shopping centers, are much healthier today. Bad debts are down, for instance. We've seen occupancies continue to climb higher, and landlords have pricing power. Going back to what I was talking about earlier, first of all, there's virtually no new shopping center development in the major developed markets. And second, demand has picked up and is rebounding. And so landlords are able to move their rents and to keep pace with inflation. And then finally, just to differentiate outdoor grocery anchored shopping centers from regional malls that everyone often thinks about when they think about retail. We think differently about enclosed malls, particularly in the United States, where the enclosed malls in the United States often have a fashion angle and apparel angle, and they don't have the necessity shop that you would see at a neighborhood shopping center, or that you would see in shopping malls in, say, Australia, where most indoor shopping malls have one or sometimes two grocery anchors. So they drive the necessity shop. So within retail, we've taken our exposure from an underweight position relative to the benchmark during the pandemic to a significant overweight position currently, because we're really constructive about the outlook for the operating fundamentals for that segment.
Thanks, Rob. I mean, that's an interesting position, given that everybody loves to hate retail REITs, given exactly what you just said about the emergence of online retailers. What's an area that's really suffered this year, and whether that's a particular sector or a region, or maybe even a particular company that suffered in 2022 on the back of maybe some of the weaker elements of what you guys look for?
So, look, there's no love for office right now. There's been a change in behavior among office users. The tenants are desperate to get employees back into the office. It's good for company culture. It's good for training. It's good for collaboration, spontaneous conversations and ideas. There's clearly a view, and we subscribe to it, that productivity overall is better when people are working together collaboratively in the same space. But behaviors changed significantly during the pandemic, and we just don't see office users coming back to the same extent that they were beforehand. So, the employers, the tenants, desperately want employees back in 5 days a week. And there's really a bit of hand-to-hand combat negotiation going on about whether it's 3 days a week, 4 days a week. In some cases, I've met with major consulting firms, and their employees are encouraged to come back 1 day a week. And so there really is kind of a broad range of behaviors for office usage. And we think that that actually is going to have that's going to add to the cooling effect for office space demand. Tenants are not necessarily committing to less space today than they had before, but we think they probably will. We think that the way office space is going to be used will probably be different going forward. Again, this is a generalization, and different industries may behave differently. But for major office markets like, say, New York, we're seeing tenants that probably are going to reduce their office space over time. They'll chalk it up to increased productivity. And if you think about legal firms, certainly every law firm lease that we hear of today, they're taking 25-30% less space than the lease they signed 20 years ago because they just do much more online. And so we think that there's a real cooling effect for office space demand. In addition, right now, the tenants want shorter leases and they want fancier space because the office space is a really competitive advantage for attracting employees. And so that requires landlords to commit more capital to the spaces than ever before. And so there's really been a bit of a de-riching experience for office investors and office landlords where they have to commit more capital. It's harder to attract and retain tenants, and the tenants want less space and shorter leases. So office is an area that's really a worry, we believe, over the next several years.
One of the themes you've had in the portfolio for some time now is beds, sheds, and meds. Healthcare hasn't had a great time this year.
No.
Why is that? Well, you would have thought that would be quite a resilient sector, no matter what's happening in the economic environment.
So you're right. I would say we're really constructive on the outlook for healthcare and for various segments. And healthcare embodies senior housing, it embodies medical office buildings, and it embodies life science. The outlook for senior housing is really quite constructive because the rebound in occupancy, the rebound in rents that dropped during the pandemic continues. There had been an unprecedented decline in occupancy in senior housing, 1,300 basis point drop in 12 months ending March of 2021. It's going to take, I think one of the reasons why the senior housing segment has struggled as an equity this year is that it's just going to take a bit longer to rebuild that occupancy than it took for the occupancy to be lost, and frankly, a bit longer than people had anticipated. The other thing is healthcare is a labor-intensive sector. So, elderly people have higher service needs, whether it's medical services or some type of daily living hospitality services. And there's been an acute shortage of labor, and that's led to very significant expense increases, which has hurt profitability. And so even though we have a constructive outlook for the revenue side of the senior housing business, there are worries about the expense side and how that eats into profitability. And so we think the senior housing has really suffered this year as equities because the ramp back to profitability will take longer than had anticipated. But our view that there is going to be a solid recovery is unwavering. It could take an extra year. On the medical office building side, look, business is fine. It's never been an exciting sector, which is one of the reasons we like it. It's a steady, call it 2 to 2.5% NOI grower each year. You have fairly stable occupancy, and you have just very small incremental rent increases. The knock against it in a high inflation environment is that it undergrows inflation, and so you don't see real rent growth. And so that's a bit of a cautionary thing. And then we come to life science. life science just had a stellar year in 2021. Very strong rent growth. And in 2022, with a sell-off in the equity market, particularly in the biotech space, we've seen tenants for lab space buildings become a bit more conservative in their space ambitions. And so leasing has really paused. And it's paused just as there's a wave of supply coming online. And again, going back to what I talked about earlier, supply versus demand, right now it looks like there's a bit more demand incrementally than there is supply. And so we're not seeing material rent growth from here in life science. And so it's just a bit of a stabilization period. But we think that the demographics for healthcare real estate remain very compelling. You have an aging demographic in developed nations. The over 80 age cohort in the U.S. is supposed to grow projected to grow over 4%, which is more than 2 times the national average. Life science, we think, continues to provide solutions for the future. You've had the progress in genetic engineering. You have a confluence of chemistry and biology, and we think that there's going to be increased demand for life science space over time. And then finally, with the MOBs, we think it's a steady eddy, and we think it will continue to be so.
Great, Rob. Well, thank you very much for that. There's some really good insight into a lot of sectors there. So I think we've covered a lot. I'm gonna end it there, and thank you very much for joining us today, Rob, taking time out of your schedule.
Thank you. It's a pleasure. Have a nice day.
Thank you.
Cheers.
And so in summary, we heard that supply and demand really matters. In combination with that good management of that, we see in the retail space where they've pivoted and we're offering good value in certain parts of the retail universe. And then within office, there's some struggles still to come, as we don't know what the demand is going to be like going into the future. And then healthcare, very good demographic profile, pushing the possibility for rental growth into the future. It just might take a bit longer to come through. So thank you all for joining us today on this program. And we have one more global perspective to go in the early December. So please come back to us then. Otherwise, have a cracking day and see you soon. Thank you.